Here we are in our financial modeling and forecasting. Just for recap, in our last class we looked at some cost outline. Then we checked on introduction to financial modeling, and we knew we were to pick from cost estimation, and I think that is where we are supposed to be beginning. So for recap, we look of something to do with model, what a model is, then main variables. We had independent variables, dependent variable, then forecasting, then classification of cost or classification of forecasting. Then after that we checked on forecasting steps, where the steps were data collection, we have data reduction, then if that is not enough, we had modeling or model building, then model extrapolation, then actual forecast. So direct what we are supposed to be doing today, we are supposed to look at cost estimation. So while trying out the cost estimation, we had begin by looking at some of the estimation approach. So in estimation approach, we have account analysis approach, we have industrial engineering approach, then we have visual fit approach, linear and regression analysis approach. So those are some of the approaches that we have in cost estimation or cost approaches or cost estimation approach. So those are some of the cost estimation that we have, and I can highlight them all. Here we are. These are the cost estimation approaches that we have. We have industrial, accounts, visual, regression analysis, and linear curve approach. So number 2, to choose the independent variable, this is the controllable variable and it is normally denoted by x. So in an equation where you have x, y is equal to a plus bx, remember x is always the independent variable and the dependent variable is always denoted by y. After that, you check on data collection, how data is collected, and we agreed before at data is just raw fact and figures that has no meaning, and it is always different from what is termed as information, where information is always processed data. After that, you are supposed to generate the model. How do you do this? Using the data values of both independent and dependent variables generated the regression model forecast. So with the data you collected, automatically it will assist an individual to generate the model. And if that is not enough, you're supposed to, after generating the model, you're supposed to generate the forecast. So using the developed model, generate some forecast. And at this point, you may plot the model to get a visual outlook of the model. Then after generating the forecast, you're supposed to evaluate the estimated cost function. How do we do this? We will ensure that the model developed and its forecast actually makes sense. If it does not make sense, that means that your estimation cost function is not valid, or it is viable, does not make a lot of some sense. So let's look at some of the cost estimation approaches or estimation approaches. So here, to begin with our number 1, which was industrial engineering approach, what does it entail? You find that this use analytical work measurement so that we derive a relationship between inputs and outputs. So in simple terms, inputs are all either goods or products that come in, and outputs are always the goods and products that leaves or goes out either in a company or in a business. For example, time and motion studies may be employed for direct labor. So these methods are suitable for situations where clear physical input to output relationship exist, e.g. for direct materials, direct labor, fuel usage, etc. And you find, but therefore it is very easy to use and understand this approach, and that is one of the advantages of industrial engineering approach. It is very easy to use and understand, and you find that as much as engineering methods are accurate, it is not possible to apply them to a number of situations in an organization, e.g. in the case of overhead costs. In many cases, these are both variable and fixed component estimation approaches. That is our number one, estimation approach. Our number two was account analysis approach. So, before looking at our account analysis approach, we always have another approach, the learning curve approach, which is this, which is the last one. You can see it here where the cursor is blinking. This, that is a learning curve approach. Let's start with the ones which are more theoretical than the mathematical ones. So learning curve approach, it always just states the effort to complete a task. That is always the main importance of learning curve approach. It states that the effort to complete a task should take less time and effort the more the task is done over time, and therefore this theory can also be expressed in a mathematical function that can be used as a prediction tool, and that is what learning curve approach entails. What about account analysis approach? So we are looking approaches or cost or estimation approaches in financial modeling and forecasting, and our number three approach is account analysis approach. So this method requires the analyst to go through the ledger account, involve cost and classifying them into either fixed or variable cost, and you will find that the total variable cost are then divided into budgeted activity level to generate the variable cost per unit that are added in fixed cost to generate the total cost function. So you know that a total cost function is always just a way of getting the fixed cost plus variable cost. So the model always takes the form of y is equal to a plus bx, and by now an individual should know what is meant by y and x. So what the y which is in the other side, it is on the left side of the is equal sign, is always a dependent variable, so it will always depend on x, and x is always the independent variable, and you can see it here what x is. You can see, choose the dependent variable. So this is the cost of predicting, and is usually divided by y. So y always depend on x, and a is always a fixed cost, or it does not vary. So you'll find that it is defined, all that I'm talking about are defined here. So y is equal to a plus bx, where y is the cost to be predicted, which is that, then x is the cost driver, e.g. the unit of output, stock, sale, machine hour, direct labor hour, etc. Then a is a fixed cost, then b is a variable cost per unit. What are the advantages of account analysis approach? Cost can be easily classified from experience, that is number one. Then you will find that greater knowledge of cost behavior is achieved, making cost control easier. That is number two advantage of using cost approach. What are some of the disadvantages of using cost analysis approach? You'll find that most of the time the method presumes that what occurred is in the past will be projected into the future, and this may not necessarily be true. What happened in the past will always remain in the past, and that is why we use the term history. If it is in the past, it will always remain in the past, and what comes to the future no one knows. So that is why it is this approach might not be necessarily true. Then our number second disadvantage of using this approach, you find that it is subjective to some extent. So e.g., different individual may classify costs differently, especially semi-variable stock fixed cost. This arises due to the classifying cost strictly as either fixed or variable. E.g., there is no semi-variable stroke fixed cost or fixed categories. Another disadvantage that the reliability and validity of the result, e.g., the forecasting model cannot be determined, e.g., we cannot measure the size of probable error in the forecast which made since the method lack statistical rigor. That is another disadvantage of using cost analysis approach. Our number fourth approach is high-low cost or high-low method approach. So for illustration purpose, for cost analysis approach, this is how we are supposed to be doing this. So an illustration, you find that QPR Limited produces a single product which is meant for local markets only. That is a company that produces products for local markets only, not for export. So the monthly demand for the product varies from one month to the other. And you find that during the month of October 2019 or 2019, 1,000 units were produced, incurring the following expenses. So expense number one is direct material, which cost 30. They are in thousands, and you can see here they are in thousands. So direct material 30,000, direct labor 40,000, fixed cost which is rent 25,000, electricity 40,000 fixed. Then property tax rate 80% variable, then technical support fixed 28%. So using the high-low or using the cost analysis, formulate the cost function. So we are just going to take a step on how can get the total cost function using the accounts analysis approach. So to begin, you just create a space here so that I'll show you how to do this. Just create a space just here, just below this, so that I can show you how to get cost analysis function. So here we will be having, can write here materials, just follow keenly, you'll see what I'm doing. After material, you can write variable cost, or you can just write variable costs, which is here. Then we have fixed cost, then we have total cost, total cost. Then there we are. So after separating them and giving them titles like that, you come to your question, and you will know that your question here is here. So this is the question. During the month of October 2019, 1000 units were produced incurring the following expenses. So direct material, we have direct material, direct labor, then we have, those are variable cost, direct material, direct labor, 30, 40. So variable cost here, you can write here direct material, then direct labor. We are solving our question, so direct material just come up. We have 30, 40, 30, we have 30, then here we have 40, we have 40, that is that. So the total here is 30, then the total here is 40. So the total cost 40, that is direct material, direct labor. So that is it. We have rent and electricity. Rent, just come here and write rent. This is the simplest analysis approach. Can write rent, then in bracket fixed, close the bracket. Then we have electricity, 40% fixed, meaning the other ones are variable. 40% fixed, So our rent fixed 25, just move it 25, then you just go up to total cost 25. Remember, this is fixed. Fixed 25 fixed, that is okay. That's okay. That is okay. That's okay. Then we have property taxes and rate 80% variable. So we have electricity 40% fixed, 40% fixed, and the total electricity, the total value of electricity is 27. So 40% of 27 is fixed and all the remaining are variable. So you just take 40% of, just take 40% of 27. You'll find that 10.8 is fixed, then 16.2 is variable. So you come here, (16.2) is fixed. 16.2 is fixed. Then 10.8. No, 16.2 is variable. I'm sorry for that. Then 10.8 is fixed cost, because we are told electricity in bracket 40% fixed, and we have the total number of in shillings. The total cost in shillings is 27,000. So if you take 40% of that, you're supposed to be getting 0.4 times 27,000. You're supposed to be getting 10,800, and that is what we have written here as 10.8. But if you take 27 minus that 27,000 minus that answer, you're supposed to get 16,200, but we have shortened it as 6.2. So the total here should sum up to 27, and that is how we are supposed to be calculating our cost account analysis. So here should be 27. We are still continuing. We have property taxes and rate and technical support. Property taxes and rate. So we have property taxes and rates. We have been told property taxes and rate for 80% variable. So 80% of 50 will give you the variable cost, and the remaining will give you a fixed cost. So you just take 0.8 times 50. So you're supposed to get 40 shillings or 40,000 is variable cost. So here we just give it a sum of 40. then you take 50 minus 40 because the total sum here is 40, meaning if 80% is variable cost, 20% is fixed cost, and that 20% will give us a total cost of 10,000. So what is the total? The total should be 50. Last but not least, we have technical support fixed. This is a fixed cost. Technical support, in bracket fixed. So that one will give us fixed cost. This is a variable cost, we have nothing, but in fixed cost we are supposed to be having 28. Then the total should be 28. So you're supposed to be getting the total number of this, total of both fixed cost and variable cost. So you're supposed to be coming here and getting the sum of all the variable cost. So you're supposed to be adding all this: 30 plus 40, 70 plus 40, that is 110. So 110 plus 16.2, you're supposed to be getting 126. So you're supposed to be getting 126.2 as the total. This is the total variable cost. So the total fixed cost should give you, if you take 25 plus 10, that is 35.8, 35.8 plus 10, 45.8. Then if you add that, if you add 28, you're supposed to be getting something with 73.8. And they're supposed to be confirming everything we do here. So that is the total fixed cost. So we have 25 plus 10.8 plus 10 plus 28. We're supposed to be getting this. That is okay. So the total cost here should sum up to a total of 200, which is here. So if they don't sum up to 200, there is an error. So you're supposed to be taking 30 plus 40, 70 plus 25, that is 95 plus 27 should give you 95 plus 27 should give you 122 plus 50 should give you 172 plus 28 should give you 200. So here you're supposed to be having a total of 200. So that is how we're supposed to be getting this question using an accounts analysis formula, the total cost function. So for you to get the total cost function, here is the formula. Let me just quiz this to give us more space. The equation is in the form of y is equal to a plus bx. That is the equation. This is the equation we are supposed to be using, and this equation should give us the total cost function. And you knew very well y is the total cost function. A is a fixed function, is a fixed cost. B is a variable, then x is an independent variable. So from the formula, even here above, you can see an account analysis approach is it should be in the equation, this equation, where y is the cost to be predicted, it is the cost driver, then units of output, that is y. So for us to get b, and what does b represent? Variable cost per unit. So variable cost per unit, you can see during the month of October 2019, 1000 units were produced incurring the following expenses. So 1000 were produced, and you can see the variable cost here is 126, and this 126 is in thousand, so it's supposed to be 126,200. So for you to get the cost unit, you're supposed to divide this by 1000 so that you get the total number of units. So this total number of units, it gives us, so even if you come to formulas, I wanted just to do this manually and avoid too much rushing into the formulas. So for you to get the function, we have a is fixed, and the total fixed cost is here. So you're supposed to get y, you're supposed to come here and get y is equal to a is the 73.8 plus b. You're supposed to be getting 126,200, everything divided by 1000, the cost per unit, which is 1000 units, and 1000 is here, you can see it here, 1000 is here, this is it. You're supposed to divide it with the per unit, so you divide by 1000, then plus, or in bracket, you're supposed to multiply everything by x. What does x symbolizes? X symbolizes independent variable. X symbolizes independent variable, and you can see it here. So you're supposed to be giving your x. So most of the time x is always the cost per unit of sales. So our equation, or our cost equation, should be this. You're supposed to be getting this. So if you simplify this, you're supposed to be getting y is equal to 73.8 plus 126.2 x. This is our equation, and that is what is required here. Using accounts analysis, formulate the cost function. The cost function is equal to y is equal to 73.8 plus, there is an error here, plus 126.2. That is our cost function. Our Roman 2, our Roman 2 need this. During the month of December, QPR Limited estimate a to produce 11,000 or 1,150 units. Calculate the estimated cost in December. So for you to do this, the estimated cost in December is supposed to be this. So that is cost per unit. So we'll just come, so we are solving our Roman 2. We're supposed to say y is equal to, this is fixed cost 73.8 is a fixed cost, plus that is a fixed cost, then plus variable cost has now changed from 1,000 to this. So you're supposed to be taking 126,200 divided by 1150, then in bracket x. So after getting that, you're supposed to simplify everything here. This is Roman 2 question. So you come down here, you write y is equal to 73.8 plus 126,200 divided by 1150, 109.74, 109.7.74 x. So that is the total. Calculate the estimated cost in December. So the estimated cost in December applies to that. So you can see we have cost to be predicted is y, the cost driver unit per unit machine hour should be that, then fixed cost that, then variable cost is b. So the variable cost here is what we have. Variable cost per unit is what we have here. So this is the cost function for our Roman 1 and the cost function for our Roman 2. So that one is what is required us to do as for now. Hope everyone understood what we are supposed to be doing. So that is it. Another method or another approach which we will be looking at the calculation later is ILO method. You find that this method takes the highest and the lowest point of as measure and determined by x or the predator variable and obtain the straight line which connects them. So this linear function will then be forecasting model, and this linear function take the function in the form of y is equal to a plus bx, where y is the cost to be predicted, x is the cost driver, ba is the fixed cost, then B is the variable cost per unit. For illustration, you find that iTex Engineering Company Limited wishes to set a flexible budget for each of its operating department. So a separate maintenance department perform all routine and major repair works on the company's equipment and facilities. So the company has determined that maintenance department perform all routine and major repair works on the company's equipment and facility. So the company has determined that maintenance cost is primarily a function of machine hour worked in the various production department. So the maintenance cost incurred and the actual machine hour worked during the month of January, February, March and April 2019 were as follows. So we have month, we have machine hours, we have maintenance department cost. So January, February, March, April. So in January we have 800 production department cost 350. February 1200 cost 350. The March 400, March 150. Then we have April 1600, then the cost is 550. Required, determine the cost function using high-low method, and using the high-low cost function above, estimate the maintenance cost that would have been incurred if the machine hour were expected to be in the above month in May 2019. So under high low cost method, here what you are supposed to be doing, you're supposed to be having your data arranged the way it is arranged. Then you will be looking at which is the highest in production department. You can see that the highest is 1600 and the highest here is 550. The lowest here is 400. The lowest here is 550. So you're supposed to be using high-low cost method, and that is where we will be picking from next time when we are solving the equation in high-low